Welcome to our eSignal Futures and Forex Forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. Before we get to the charts, I want to leave you with this thought. So important that you have a static trading plan. Once you have that static trading plan, then you can implement that consistent systematic process which produces your benchmark. We'll show you our benchmark today, as we have been doing on a weekly basis. That benchmark is so important because it gives you a record of the trades that your methodology is producing. Your goal is going to be to try to match the benchmark's performance, and we'll touch on that again. First market we're taking a look at is the Australian US dollar. Aussie had a pretty good turnaround on Thursday. That really reversed our 5-day pattern down. Probably a lot easier to show it to you this way. I would rather see this than charts for the most part because I love the numbers. They help me remove the emotion from any decision making, and they also help remove my own human error in there too. It's often too easy to think sometimes that you can read the tea leaves, but the numbers to me are more reliable. And here's the Aussie. You change the 5-day down. On the other hand, that 10-day is still up, and that grand pattern, that long-term pattern, is still up too. So Aussie definitely a different animal here. And we pop out to a weekly chart, and you'll see that long-term support right there. So I'm really not interested in going after the short side, maybe other than a very short-term day trade, because you're looking at it here on the weekly. Look at that pretty stout support just below in that market. Next market will be the dollar Swiss. Dollar Swiss, it's right below or right at that 625 potential resistance right there. However, it hasn't really respected that level. I mean, if it was going to respect it, it gets to it, it pops right down, see as it did there, but it just keeps coming back to it. Now it's walking along it. Again, I have to go to the numbers, and this is a part of that static trading plan that we use. This is how we determine which way we're going to trade in a market. And if you look at that, all those lower time frames are up, and just as important, they're in line with that primary, which is up also. So Swissy, we continue to look to buy dips there. The dollar index, sideways market right now, you're looking at a 50% retracement level up there. Yeah, that may or may not be a reason for that market to slow it down, but when you look beyond that, you don't have really resistance until, well, naturally the par level, and we think that's a pretty good shorter to intermediate term target par. And the dollar, and we think 102.52 is really where you're going to go. And we mentioned the importance of the benchmark. Let's show you our benchmark where it stands now at the end of the month. End of February, continues to work its way higher. Here's what's significant to me. Here was a euro buy signal. This is the first time we were on the euro. That was the first buy signal the method generated pretty much all year. Well, it was a small loser. That's okay. Then it comes right back with another sell signal. Nice profit on that one. So, that to us, that correction in the euro was short-lived. And then, boom, back to close the week, you had nice buy signals in the dollar index. So, back on the long side. The reason I'm showing you this is, well, it's our benchmark. That's the product of that static trading plan. But just as important to traders is it reflects the mindset of traders too. If you're not making money on one side of the market, and for example here, but then you are making money on the other side of the market, what do you think you're going to do next time? Well, you're going to focus on that side of the market that's rewarding you, that's paying you, and you got to follow the money. It is trading. It has to be performance based. So when it comes back to the dollar index here on the daily chart, which way you think we're leaning? Well, we're going to look to continue to buy dips, and as I said before, I think par is an actual upside target, but I think 102.5 more so. And here's our ratio, our RTT ratio. Again, that's very much a part of our static trading plan. All the patterns are up. Not going to fade that. Next market, the euro. The euro, we talked about the possibility of short covering rally, and nothing really came from it. You look at the RTT ratio there, again, just back to the straight numbers, all the patterns are down. Significant support level here broke down. So it's definitely back to selling rallies, not just, of course, long term, as we've been the whole time down long and intermediate term, but also short term. As a day trader too, we're back to selling rallies in the euro, and you see a pretty thick line there below 110 all the way down at 108 3/4 or so. That's a pretty significant longer term level for us. You pop out to a monthly chart, and that's a big level. That's the 2/3 retracement. If you go all the way back to the low in 2000 to that high, and that 2/3 is a big level. That's straight out of Dow theory, and you look at 2/3 on all time frames. That's a pretty significant level. So we think that's our overall target there in the euro. So we're back on the short side there. So as short-term traders, our focus is back on selling rallies. Here's the gold market. Pop it down to a daily chart. I mentioned that 2/3 level long-term in the euro. There's our 2/3 again in the gold. Look at that. If you take that, the low, the 2014 low to the 2015 high, and you extrapolate that 2/3 down, look at where gold bounced at. So gold finding short-term support here. Definitely gold's one to watch. That's a significant level here, but 1140 down below, also a big level too. So gold's got to put up here if it's going to try to recover or not. And I've said it many times. If you look at the weekly chart, here's our focus. Gold's making a steady pattern of lower highs, lower lows, lower lows. So in our book, that's a bear market. Take a look at the dollar yen, and that's the weekly chart. Look at it on the daily chart. We've said it many times. You know, we really don't have much of an interest in this guy on the upside. That doesn't mean that market can't take a flyer and probe above resistance, probe above the 2014 high. We see 23, 28 or so. We see 23 and a quarter, 23 and a half. Certainly an achievable level, and you know, we're big on even numbers and half numbers as most traders are. And you look at how close you are to 125 even. So to me, that wouldn't be a stretch at all. However, we think there's easier pockets to pick in the currency markets. But hey, you know, as long as you're buying dips, if it's producing, you're going to keep doing that. And that is what makes these markets tick. When you're being rewarded for one side, be it buying dips or selling rallies, you're certainly going to stay on that one side of the market. Hey, let's take a look at U.S. interest rates real quick, because this is going to be the big one for all of us right here. Let me pan out to weekly. You see that massive sell zone in the treasuries. What's going to fuel the dollar higher? To me, it's going to be higher interest rates in the States. What would pressure gold lower? Again, higher interest rates in the States. When you see this trend line get taken out in the 10-year note, what that means is we're going to see higher interest rates in the U.S. This is the 10-year note market. Here, let me flip it around so you can see just straight rates. This is basically the opposite of this chart. Here's straight rates. And you can see the long term, this market has bottomed out, right around 1.5%, the 10-year note, and it's currently just above 2%. If you see that market get a little bit higher, start to take out resistance levels, that's going to be a sign that you're going to see higher rates to follow. Higher rates in the States are going to be a reflection of a more normalized business cycle in the global economy overall, and it's going to be dollar bullish. It's going to be bearish for the foreign currencies, bearish for commodities, also gold being one of them. Hey, thank you so much. Let me leave you with this thought, because it's so important for us and what we do and what we teach. And if you go back several years and you look at our previous forecast, what we're saying about the market and how and why we were able to be as accurate as we were, it's all about this. We have a static trading plan. We let the market provide the numbers that we base our analysis on. So you must have a static trading plan before you can implement the consistent, systematic process which produces your benchmark. My name is Jay Norris. Thank you so much, and we'll see you next week.